The session with Sadhguru, for those of you who didn't join us, he talked about so many things that struck me. And one of the things that struck me that's related to this session is he talked about the importance of listening closely when we don't understand. That, you know, we tend to listen very closely and nod when we understand and we believe the same things and we agree. And then we stop listening when we don't understand or we don't agree. And so I'd like to just keep that in mind, to listen closely to what we don't understand and what we don't agree with, and to stay open. And he also talked about joy, you know, how important it is to be joyful, especially when you have work that you really care about. To be joyful because people want to be part of something that's joyful. And so this morning, we are going to be joyful and lively, and we're going to listen, and we're going to be really provocative. And so I'm going to overshare this morning, and Dan's going to kill me later. But I have to say that this was the most challenging breakout session that we have ever planned in the history of SVN gatherings. I know, he's going to kill me later. Now, part of it is that they're impact investors that are just incredibly passionate about their work, and they're very busy, and it was impossible to schedule a planning call. So this is going to be very spontaneous. So we haven't had a planning call. We've had meetings in the elevator. In fact, I think there was one meeting in an elevator that almost came to blows about how provocative this session could be. We've had a couple of near calls. Anyway, this is going to be spontaneous. They're going to have a discussion. We're going to bring you into the discussion. But the reason why I wanted this to be provocative, and I asked Dan to make it provocative, so you can shoot me if it doesn't work, is because we have so many assumptions about impact investing, and we spend a lot of time talking to ourselves, to the SVN community, and we think it's really important to talk about what's working in impact investing, but also what's not working, and to keep in mind the size of impact investing today so that we can really get serious about what the opportunities are to help this go mainstream, because we're definitely not even close to making impact investing mainstream. And there are so many promising things that are happening, but we want to be real about what the challenges are so that we can be clear about what the opportunities are and how we can work together to turn those opportunities into reality. And I see I'm getting the hook. I didn't think I would get the hook. All right, so you guys can introduce yourselves a little bit later, but are you okay? He's pissed at me already. All right. No. So these are all very, very interesting, very accomplished impact investors. They're all doing impact investing in their own way. I'll let them say a little bit more. Dan Levinson from Main Street Resources, longtime SVN member. Kevin Jones is from SoCap, Good Capital, Impact Hub, and he's an Enneagram 8. Which means he's a confronter, all right? So you're going to see that come out a little bit later today. Lisa Hall, CEO of Calvert Foundation, who's decided to leave us all. She's moving to the Netherlands because she's sick of us. And she got a great opportunity to work with a family. Is it a family? Family office, and she's not really sick of us. And Sonia Lowe, who's a brand new SVN member who works in the States and in Europe. She consults with corporations and family offices and does some really interesting impact investing. So please join me in welcoming our impact investors.
I did have some nice words to say about Deb Nelson to start this thing, but I think maybe. No, I would like to say, so seriously, like anytime we back a company, the team is critically important, the mission's important, the product and everything else, but the one thing that really matters the most is who's the CEO. In the nonprofit space, it's who's the ED. So despite that, we love you and you're the greatest. And no, this was a little challenging. It's a very tough space. People feel really strongly about impact investing. And so thank you. Still smells like you, though. That's a problem. So that's what happened. So okay, well, I bring a lot of passion to the table. So I would say I'm a diehard impact investor. I believe the day will come, hopefully in our lifetimes, although everything does hurt, that we will see impact investing far outweigh traditional investing, that we will see the day when traditional investors is like the plague that used to be here, and we wised up. And so that's what I bring. And also my biggest sort of unchecked dream, and well, besides the soulmate, just put that out there, is to I might be an 8 also, which is probably part of the problem. So, is to run an impact investment fund in Northeast. And I'm working with my buddy Ronnie on that too. So we bring this kind of hardcore, how do we get this done mentality. And yet when we look around, we see some of the most spectacular people that we know on the planet that have been pioneers in this space at RSF and Calvert and SJF and everybody else. And then we see the companies like from last night. And there's Jeff with his daughter. Oh my God. Like, is that a warm fuzzy for the whole space, is to see the second generation. We're going to hear a little about that later. So despite all that, Deb's like, you know, we know how easygoing you are. You need to really be provocative. So we came up with this idea. So let's try to give impact investing a report card. And so to have a report card, you have to know what you're being measured against. So we said 2 things. Let's define impact investing as relevant to this room. So we are not talking about just screens against tobacco and firearms and all that stuff, and we're not talking about shareholder action. We're talking about how much money is in real firms aimed at helping. How many people in this room run a company that might benefit from, you know, impact investing funds? All right, so we're talking about your space, and we're saying what's the goal of impact investing within that space, and our goal would be to be the vast majority of money in this country is impact investing money. So that's a big goal. So then we measure what's the report card. So on the one hand, in the American capital markets, and you can define it any way you want, is about $150 trillion. And in impact investing, as we just defined it, is maybe $10 billion. So it's around 1/100th of 1%. If you look at it differently and you say, how many firms are in the United States specializing in helping small companies grow? In mainstream, there's thousands, tens of thousands, you know, the best and the brightest and all that, the hedge funds. And how many are in our space doing this? And there might be 10 or 50 or 75 or 30, depends how you count. But so what that is that's, and then if you ask anyone, almost anybody in the mainstream space that's managing $1 billion or $10 billion, how's your impact investing program? They're going to look at you like, what's that? Right? I get that experience even with foundations all the time. We don't do impact investing. Our job is to make the most money we can. So when you look at the report card for impact investing, if you want to be provocative, we're a tiny piece of the puzzle. We are not material yet to the overall economy in the United States or the markets, and we are not yet cool in any way, shape, or form. We're not on people's mind. And so we thought we'd have this discussion today. You can challenge those assumptions. You can look at it any way you want, but that's really the framework for the discussion. So we're going to do 3 things around that framework. One is, what are the systematic barriers to institutional investing being a bigger player in all that? So what are the things that, not to celebrate the wins, there have been a lot of wins. So what is in the mindset or in the institutions of the major money sources in this market that are keeping us from being cool? That's 10 minutes. Then we're going to do 20 minutes on, that's the negative in a sense. That's the mountain we have to climb. So then we're going to do 20 minutes on what's a strategy, what's a picture, how can we paint a story that takes impact investing within some period of time to basically ruling. Then the third is we'll leave hopefully 30 minutes, except you and I just spoke too long, 30 minutes for Q&A. So if you have any good questions that are nice and easygoing, we don't want them. If they're confrontational, if you want to come up and hit one of us, go for it. Okay, so first we're going to do 2 to 3 minutes each, and you guys can jump in whenever you're ready.
Young guy.
Okay, it was us in the elevator. 2 to 3 minutes on what's keeping us here.
What's stalling us? I think, we have outmoded mythic infrastructure, basically. We have unchallenged assumptions, and I think they were exacerbated a couple years ago when the Jen folks and the Kathy Clark folks decided that we would have to buy into that bifurcation and say your impact first or your return first, rather than saying, like, if you want transportation, are you walking first or biking first? Well, it depends on where you want to go. But they didn't do it from a holistic sense of what the person wants to do. they split the field and they bought into old-style binary thinking of saying you're impact first or return first. So I think we have, the intermediaries who were storytellers did a dress for success thing rather than being who they were. So that's probably, we have to extricate ourselves from that story. And Jed Emerson told me that last year, and I'm usually about a year behind Jed. If you don't know Jed's stuff, he's the guy who really thought all this stuff up, really. And blended value was his way of looking at it. But he jumped into a binary thing because, there was being paid, whatever. And he realized that's the biggest mistake he made. So I think, mostly in this field, you're stuck with Jed's best thinking and Jed's mistakes. And that was his most recent mistake, and I think we got stuck.
So, jumping right in, I think that a lot of the challenges that we have are because there's not enough infrastructure in this work. There aren't enough intermediaries, there aren't enough organizations that actually help people and empower investors to be able to make these types of investments. So we saw a lot of hands of people who could benefit from impact investing. I'm curious how many hands of people who are actually impact investors. Right? And this is about as biased a crowd as you're going to get in this space, and we didn't even have half the hands. And so what's keeping people who would be inclined to invest their money in a way that was aligned with their values from being able to do that, besides wanting to go out and dance? What's keeping that from happening is there's not infrastructure. And it's not just infrastructure for individuals to be able to do this type of investing, but also for institutions. I think we get hung up a lot around the terminology, but practically speaking, there aren't, as the yogi would have said this morning, sensible ways for people to be able to make these types of investments. So you think about the mainstream markets, traditional investing, there are investment banks, there are financial advisors, there are all types of systems and processes in place that make it easy for you to go out and buy a mutual fund, but not easy to be able to direct your dollars into businesses or to nonprofit organizations or social enterprises that are aligned with your values.
I would absolutely agree with what Kevin and Lisa have said. I think the other thing to keep in mind is that we live in an extraordinary time of restructuring in the fund of funds world in general. So just to give you an indicator, 6 years ago there were 2,000 venture capital funds in Silicon Valley. Today there are 360. By any other measure, that's an implosion. And I see funds every day. I see companies every day. I see funds that show up and really want to do business as usual. And the reality is that business as usual doesn't exist anymore. So I tell fund managers who approach me, what if this weren't a fund? Could you still create the sort of returns that you're talking about returning? What if you structured a holding company? What if you did something different so that it doesn't look like a fund on paper? And a lot of people can't answer that question. And I think with the same creativity that you've brought to ventures, it's important to bring that creative mindset to the structuring of the ask for capital. And in many ways, you have the liberty to do that because the market doesn't have the rigid infrastructure. And the most successful investors that I see, I'm very privileged. I work with a gentleman who is has 9 zeros in his net worth, right? And he invests in a club with 50 other guys around the world, and yes, inevitably they are guys, who also have 9 zeros or more in their net worth. And these club deals are fascinating to witness because the reason they can generate extraordinary returns is not just because it's a club deal, but also because they are not restricted by mandate. They're billionaires. What do they care? They don't answer to anybody. And I think in many ways that's a very useful thing to keep in mind as we structure our ask to the capital markets. Because if we don't take that creativity, then we're just going to get mired down in the same inertia that is governing every single one of the private equity segments right now. Private equity funds that are on fund number 11 can't raise fund number 12 because people go, sorry, we don't believe you anymore. And so this is a great opportunity for us to help redefine that.
So can I bring up one more challenge? So, you know, people talk a lot about there's not deal flow. And that is a common mantra these days, not enough deals, not enough pipeline for folks to actually be able to make these investments in a direct way. And I challenge that notion because I think that there are actually a lot of what I call investable deals where there's good cash flow, they're quite profitable, even, you know, startups which have a lot more risk but have great concepts and ideas and reasonable projections and a good team that you could invest in. There are a lot of investable opportunities, but they're not necessarily investor ready. And you know, it's terrific to have a good, strong leverage ratio, but if you can't communicate to an investor and you have no idea what a leverage ratio is, then you're never going to get investment into your deal. And I think as we think about trade associations and groups like SVN and how they can be helpful to this field, you know, some of it is thinking about how do you get to diverse populations, whether they're global or here in the US, and as I like to remind people, last time I checked, the US is part of the globe. But you know, whether it's here in the US or it's abroad, really thinking about how do you cultivate and support communities and cultures that don't have the resources to know what a leverage ratio is, but they may have a business that in fact has been operating for 5 years and has a terrific leverage ratio. And I think that that's part of our work to do within these organizations.
Thank you. Okay, so what I heard in terms of structural challenges are there's a couple of myths. So one is impact and return don't come together. It's usually one or the other. That we lack infrastructure in the space, both to support companies that need money and to support investors that might want to provide capital. We lack sensible ways to do this. Yeah, the days are over when investors are going to jump through hoops. I mean, there's too much fear. And so the market's restructuring is also a big deal. I totally agree. A lot of money has gone from the fund structure to the high net worth, which keeps getting higher. So most of the money now in our investable economy is in the hands of family offices, and they are not psyched about funds. So we might be old-fashioned already, even though we consider ourselves cutting edge in terms of the way we're talking to the money that we want. And so that's almost the biggest point, that we're great at talking to ourselves, but if we want to go become half the market, we're going to have to talk to the market, and I'm hearing we don't have that language and that approach. So any other last chance on structural challenges that we need to deal with to become a big deal?
Yeah, that limited partners are limited is probably a problem. You know, well, so one of the things we've done with our fund is we had one exit, and it's a good one, and we're heading to another one that will not compromise the mission. And another company, they're progressing, and we invested when they were at $1.5 million. They're at 10. They're heading to 15. And the nightmare is that they'll sell to Nestle or Kraft or whatever. And so, but we got our limiteds involved in that, and they're trying to help us manufacture an exit for them that doesn't just triple their money, but that nobody wants to be Ben Cohen. You know, I mean, sorry, but you know, the tragedy. I got into this because of the tragedy of Ben and Jerry's, and trying to save that from happening. And so, I have mission insurance in 2 of my deals, and 1 I don't, and that's what bothers me is, and so it takes more than the professional to create mission insurance.
Exits is a big deal.
It's a phrase I made up, and it just means that it won't be like Ben and Jerry's, that when you sell, the company won't get worse. I was volunteering with the nonprofit Ben and Jerry's shops when Unilever bought them, and then they said if 40% of the workforce and people in like the marina in San Francisco knew that 40% of the workforce were former gang members from the Big Block gang, would they buy more or less ice cream? And they said, well, they're afraid of black folks anyway. If they find out they're doing workforce development, they won't do it at all. So all those went away. So keeping Ben and Jerry's disaster from happening again.
Awesome. We're just save the questions till the end. Yeah, they're not a bad company. Thank you. Hold on. I appreciate that. Deb,
And
did
the
you
nonprofit
plant this
shop's moving away.
confrontational part? Are you serious? Hold on. Okay, this is great, and this is why, even when a company does great, it's not always good. So exit strategy, protecting the mission is a massive issue. Okay, so let's go back. So report card. We're a sliver of a sliver. We're not on people's mind. We're not cool. The impact investing is not where we all want it to be. There's very significant structural challenges. Any one of these is a really big deal. So I believe, and I love this process, I believe that if we want to get someplace, you have to first say, where are we? What tools do we have in the backpack? And is it possible to get there? So really the main issue here is what's a possible story, strategy? You guys are all very deeply involved in this space. We have a little more time on this now, and then there'll be plenty of Q&A or boxing session in the corner. Now that we're on the same team, that's going to be piece cake. So why don't you guys do like 3-4 minutes each on, and then we'll have more mixing it up after that, on what's a possible way, and I'll paint it even further, that in 10 or 20 years from now, impact investing is accounting for 1/3 to 1/2 of the mainstream investing in this country.
Well, one of the two areas where I see a lack of structure is when entrepreneurs approach us directly. More often than not, they are approaching us because somebody knew a friend of a friend and they somehow got an introduction. That sort of haphazard flow of deals is really unhelpful, because for us, we have to be able to judge whether or not this is the best of breed type of company that we're investing in this particular sector. And yet, if you are in a family office or if you work for a high net worth individual, as I do, I can't systematically do that. So I would love to be able to rely on infrastructures and networks that are assuring me that they're filtering constantly. So that would be a helpful informational infrastructure that could be built or is accessible. The other is with regard to new ways that investment capital is forming around investable ideas. So in the last 24 months, as we have shifted away from fund investing, we invested in funds and impact funds in early 2012. We're only now coming back to it towards the end of 2013, really early 2014. And in the interim, what we've seen is some incredibly interesting fund-like structures that are not funds. So the fund manager is still governed and remunerated in a way that looks like a fund, but the capital is not held captive. And for the investor, what it means is that we're not sitting there paying a management fee on something that we have really very little certainty that it's going to work out. And I would love to see the dissemination of some of those more creative fund but not fund structures out in the market, so that as people ask for capital, they can come back and say, actually, we've thought about it and we don't need a 2 and 20 structure.
Sonia, what are the core terms that make the non-fund funds attractive?
So probably the most attractive one that we have seen in recent memory is what they call a series structure. So there's a holding company. That holding company requires a very small commitment by the LP. And then underneath that holding company are a series of verticals. And they can include real estate, they can include greening, they can include manufacturing. And every single one of those verticals, then the investor, if you're invested in the holding company, and it's really a nominal amount, then has the right to invest in whatever series they want and feel they can bring expertise to. I mean, Kevin, your comment about LPs not being LPs, that's absolutely what a lot of these families want to hear is, they've built their wealth by doing industrial things. And if they feel that they can be helpful without being overly disruptive to business as usual, and that's the big caveat, they're happy to do it. They would love to get involved in businesses on an earlier basis because guess what? They all know that their R&D cycle is moribund. And so they would love to be able to crowdsource better ideas, and this is another way for them to do it. So the series-based structure is something that we like, we've seen it, and we are investing in it.
So I'm going to take it from a slightly different perspective, and it's about leveraging your personal power. I think we often make this impact investing work more complicated than it has to be, because it truly is about aligning your values with your money. And that's whether you're an individual or whether you're an institution or whether you're a trustee that influences institutional funds or whether you're a policy holder at an insurance company. That really, and I say this a lot, but I truly believe that it is all the people's money, right? The bank money comes from depositors. The pension fund money comes from pensioners. And I think that we can follow the lead of the future generations who are already showing us what they can do through their political power and the massive changes that they made in the last 2 presidential elections around their political power, their purchasing power, and what they've been able to do in areas like free trade and organic. Who would have thought 20 years ago that Walmart would offer organic produce? And I think that the future generation has already started to put their money where their values are, and that there needs to be more of that when we think about investing. And you really, as an individual, are in a position to connect the dots for decision makers, for gatekeepers, by just asking questions. When you sit down with your financial advisor, and I won't ask what might be perceived as a personal question, how many people have financial advisors, but I bet that many of the people who didn't raise their hand when I asked if they were impact investors have financial advisors. Have you asked your financial advisors, what impact investing product do you have that would fit my risk appetite, that would be a suitable investment for me? And if they come back with a no, the next question should be, well, I'd like you to do some research around that and try to figure it out for me, because it's really important. So I just got my timekeeper, so I'm going to finish there, but I'm glad to come back to that point when we get into the Q&A.
We're saying what will move the needle on some of this stuff. One of the things we're looking at is a founders pool, and we're finding there's a lot of pretty mature social enterprises that don't want to be Ben Cohen, the tragedy of Ben and Jerry's. Sorry, but it is. It's great for some suppliers, but there's no nonprofit ice cream shops because of the sort of the implicit racism inside folks. If they made a rational decision, if they knew that 40% gang members were handing me ice cream, would I buy more or less? Well, they buy less. So, but anyway, there's founders pool, and I'm talking to social enterprises from 12 to 100 million who are interested in taking some money off the table, and they could do something like a dividend-like structure, 5 to 8% on an annual basis, and then that would give people 5 or 6 checks with a letter. And I got the 5 or 6. I got a check with a letter on what the thing I got into after the tragedy of Ben and Jerry's was Evergreen Lodge, which actually created a real job for folks coming out of halfway houses that came out of Juma Ventures that was sandbagged by the tragedy of Ben and Jerry's. And so, but it gave me 12.5% return on a real estate deal up in the Sierra. It was a bed and breakfast, and there was a workforce development thing where kids from these places were trained in hospitality or in restaurants, and then they got real jobs. And my risk as an investor was, well, if the mission goes bust, I get 16%, because there was a hard cost of $300,000 for the mission. And I had friends who just said, 12.5 looks good, but I shouldn't sacrifice any money. If I'm investing, I give over here. And so it helped me when people were telling me, good cap and SoCap were bad ideas, to get those checks and letters. And I would bring friends in because I couldn't cash them, saying, here's the check and a letter. So I think if we get a structure where they take some money off the table and you get a check and a letter reminding you that the thing works, even though you're doing crazy, risky, change the world stuff, I think we can cause people to overcome their risk aversion. So I think that structure is going to be good.
Yeah, I'd want to use the minute that I had left to add on to that, which is, I think we have to be willing to take risk. And, SVN, there's a lot of wealth in SVN, and there's philanthropy going on, and people aren't necessarily using it to take risks in businesses that are socially conscious. And until there's more, until there's more risk-taking, that we're never going to be able to demonstrate what's possible. And that part of what has to happen within the infrastructure is more individuals and philanthropic institutions being willing to go in with first loss capital, taking some risks so that we can prove to traditional mainstream investors that these deals can work.
Do you guys want to kick that around a little bit? Anything we've just said on the positive side? What I heard was, I kind of reordered it, but I hear that we need to develop infrastructure within the space, and particularly on exits, which is what a founder's pool would do. So how do companies cash out if they need to? That's their call, but without threatening the mission. And the third is, to get there, we might need to take a little more risk. And if we sit back and wait for someone else to do it, wait for the market to do it, wait for something sensible, GE to do it, it's not going to happen. So we're still in a very early transformative time. We still need pioneers. You know what I'm saying? It's the 1700s. We're going to Oregon. It's not a lock yet if we want to get there. And then the fourth thing is, though, maybe if we just hang on and do the work, the youth will come and save us. It worked in the 60s. So let's take a couple of minutes just with the panel on the things that might work, and then we're going to do Q&A.
Chair for you.
Well, images, pictures, things that are going to help us get there.
Well, I want to hear what Josh's question is.
Didn't see Josh raise his hand. But well, okay. Special treatment?
We're off the rails now.
No, I was making a joke about it. If we let you ask, then everyone can ask. But we can't open it up for Q&A because I think we're done with our presentation. And I love the fact that everyone's jumping in. So, no, Josh is up. No, but hold on. Wait. We need to give you a microphone because this is important. So we need a runner, and
you can share comments too, not just questions. Please, comments.
But I would say there's a lot of hands in small time, so try to be, except for Josh, as brief as possible with your question or your comment. And the Ben & Jerry's thing is done.
I promise I won't be brief. If any of you read The Big Short by Michael Lewis, there's a wonderful comment which was kind of said in a kind of indelicate way, which talked about this whole area of private equity and private investments and other stuff. And he basically said something that I think we have to remember. He said that private equity is the pimple on the butt of the bond market, okay? That really the finance of this country, and I think this is true for mostly, for most people out there, it's not about how much I can take to put into early stage companies. It's how can I use the resources that I have? How can they create an income, right? And also change the world. So I think it's about financial products that can deliver a return above 5%. Or 5 to 7% that can change the world. And I think we have to think about that. Now, I'm very involved in early stage ventures. I think it's really important. I'm all in. Kevin, you're all in, and I think people that have access to resources, it plays a very important role. And a lot of our companies are growing, and it's easy to finance them when they have millions of dollars in revenue. The question is, how do you get them there in the first place? But we need products that can have income, and that's what people have to think about for the long haul.
Thanks, Josh. Do you guys want to respond? Yep.
So I think that that's absolutely right, and obviously Calvert Foundation has been offering a fixed income product for the last 20 years, so we're big believers in that. But in order to get to the later stage companies that actually are generating cash flow or a predictable income to pay off fixed income, Somebody has to take the risk in the beginning. And I think Calvert Foundation has partly done that. We were early in the Evergreen deal that Kevin talked about, and we're part of Good Capital. But somebody has to take that risk in order for companies to get to a later stage so that then you can make a loan, and then it can be predictable income. So.
Next question.
So how do you prevent autocorrelation? How do you prevent just the scaling and recreation of the existing capital markets that we have, right? Because you're talking about finding new people, but I've seen market scale, commercial mortgage-backed scale. It's just a new market, and we're nascent now. But if you don't differentiate how you cherry-pick the deals and prove out the market, we're going to replicate exactly what we have with just different gatekeepers who've co-opted some friendly language. How do you prevent that? Because there are a lot of deals that should be done that aren't getting done. And it's that same question. Oh, we don't know any minority managers.
So to rephrase that, would you say if this market develops, it's going to tend toward the capitalists and all these guys are going to sell out for the big bucks when the day comes? What's the core question?
But all the biases inherent in the existing system that created the need to do more social impact investing. I'm not throwing capitalism under the bus. I'm saying that there's a bias and a mindset in how you look at what's a financeable deal, whose deal gets done. Equity matters in that as well as the financial equity, right?
Yeah, we are calling it impact investing, though. So there's core assumptions underlining all of our thinking, which is that it's capital-based, we want a return, and the whole separate conversation could be had with how come the foundations aren't taking the lead and totally re-looking at what it means to be a business. Why aren't we all copying Gar and doing co-ops, you know? And Susan Witt, who runs Schumacher Center for New Economics that I chair, our core discussion is it's the economic system that's really the issue. But for today, we're operating within that system. But I would ask, there's some people here with some really significant international experience where they look at the world completely differently. So, and we don't always look so good, to your point.
Completely agree. I think that having lived overseas as an American during most of the financial crisis, not a popular thing to be, right? Tried to change the accent around a bit. One of the ways that we have tried to move away from the status quo is that we try to pick managers that look a little bit different. So we're investing not in first-time managers. We don't have that big a risk appetite, but we're investing in second and third-time managers whose first funds maybe were very small, 20 or 30 million, and now their second fund is 100 or 150 million. You know, there are all the scary statistics about investing in a fund that's subscale, so we had to keep that in mind. And when you're over 100 million, you still have some degree of institutional onus, you know, in terms of due diligence, in terms of track record, et cetera. We're breaking away from traditional fund models, as I've said before, and we're doing a lot more direct co-investing. So we are actually taking the time to look at deals and to look at entrepreneurs, which is a lot more work. But we found that working alongside the fund manager and actually getting involved in some of the companies is producing greater return for us, greater visibility, transparency, and we feel is going to create a greater financial return for us. We're on a tremendously exciting learning curve and feel very empowered by that direct co-investment process. So those are some of the ways that we are shifting away from the way business has been done before.
And can I just have 30 seconds on that? So I'm not a big social metrics person. My theory on social metrics is that it's a little like financial projections, that they can be easily manipulated based on what your assumptions are. That being said, my thinking is evolving, and that this is the way we will differentiate what we are doing in impact investing from the mainstream markets is by actually measuring social outcomes. And so I think that that is one way that we make sure that this work doesn't get co-opted and just called something, and really it's the same old thing that's been done for centuries.
And I think a problem with social metrics is that you still have heroic agency. You know, like everybody, your water filter wouldn't have worked if somebody else hadn't built the road, you know, the year before, all that kind of stuff. And you're only supposed to count the water filter and not the folks that made it safe. So, you know, that's wrong too.
Hi, Lisa Hubbard, founder of the Heroes Economy. Like you, I share a dream that entrepreneurship, when people make a decision to go into entrepreneurship, that they place doing good at the core of what they decide to do, and that we accelerate the growth of business as a force for good and take on more of the social and environmental challenges. So that's my standpoint, and I'm very excited about accelerating this growth. So I'd love for you to share and elaborate on what sort of infrastructure you need as impact investors to, make social entrepreneurs much more investor ready. We want to inspire this new generation, but we also want to equip them right out of the gate. So if they decide they're going to take social entrepreneurship as an education, how do we get them ready to go? And then how do we help you to filter the deals? I guess what I'm asking is, can you elaborate a little bit more about what you're looking for, and how can we help you to build that infrastructure?
Yeah, it's almost two questions. So, and just to pose it this way, one is long term, if we want to be one half of the money in our market, we're going to need infrastructure just wildly beyond almost anyone's comprehension in the room. So we're going to need, companies like GE focused only on this. And that's what we need if we want to be half the market. But it's just not even worth, it's so big, and we have so little right now. But an interesting question is, what can we do today with the people in this room that would move the needle for you guys as major investors? It would make you more comfortable, that would make it easier for you to access.
So this is maybe a little controversial in a room mostly of entrepreneurs and for-profit minded, socially conscious but for-profit minded individuals, is don't be afraid of subsidy, right? That I believe that subsidy is actually a really important resource to leverage this marketplace. And it happens all the time in the traditional markets, right? Like, would there be an Amazon if the government hadn't invested in the World Wide Web? No, there would not. And so, we have to look at the power of advocacy, the power of political pressure to move subsidy resources into the space. And so I think that that's one thing that can happen. I think in terms of making businesses investor ready, I think the biggest thing is around their financial knowledge and their accounting expertise, whether that's through an outside shared resource or that's paying for an accountant to come on for a year or two. They'll pay for themselves over time. But generally, entrepreneurs have really great ideas and not necessarily a lot of financial or accounting acumen.
We have a question over here.
I would echo that. I think also having uniformity of information. So one of the things that's most frustrating for me, given the time-limited world that we all live in, is to get a set of company financials or a description and it says, "We look like nothing else you've ever seen." Yeah, okay. So you still have sales, you still have cost of sales, you still have margins. I want to be able to see some uniform, plain vanilla financial information. I really don't want to see things that have esoteric terms. Then I have to think through, well, what does that really mean? Because, again, you get 2 minutes of my time when I'm stripping through a business plan. And that's not meant to be unkind. It's just meant to be statement of fact.
Thank you. My name is Joe James. I have a company called Agritech, and we're involved in converting biomass into a carbon-rich substance from which a number of products can be made. And we really have a global opportunity to use our technology. I'm also a former 33-year economic development professional, so Lisa's comment about subsidy and the earlier questions about infrastructure is something that I believe I have some familiarity with. I believe that I was an impact, primarily lender, many years ago as we tried to revitalize communities by attracting in and growing certain types of businesses. And we provided low-interest financing and grants and other things. So I would say that in today's environment, I'm familiar with a number of technology-related organizations that are positioned, I believe, to be good intermediaries for projects that might be considered by your organizations, and that I would hope you would reach out to them as resources and potential partners. And I've noticed some impact investing connected to clean tech companies and organizations that I've been active in before. And I hope there could be more of that. And I would like to get your panelists' comments on that.
I think probably one of the best economic opportunities in the U.S. right now is M-Health meets Obamacare with cultural literacy as the way you'll get bigger adoption. The working poor are now the best customers for the healthcare system. If they are in insurance, then the cost of them going to the ER is now counted with a person. So, if you can save 4 trips to the ER from somebody that's been there 6 times in a year, then you can save that system $60,000 and you can get some of that. And it works best around chronic diseases, like type 2 diabetes, things related to PTSD, and some asthma-related kinds of things. And nobody who lives in the best neighborhood is going to save the system $60,000 based on just pretty minor, really, it's not even behavior change, it's passive monitoring. One company that I like as an example, Ginger.io, it's a smartphone app that you download and it knows your calling patterns. When you're healthy, you call your wife twice a day, and you call, your mistress once a week. You call your son whatever time, and they know. Well, no, I'm trying to make it, so that the guys in this room can identify with who they're not. Yeah, exactly. But anyway, but the point is, then it knows the pattern of isolation. This is, yeah, that was wrong in so many ways. Yeah, I know. Yeah, that was, yeah. But no. I want to finish this deal. It knows your pattern of isolation, and there are healthcare workers who will come out and you tell them you're feeling good, but they know you haven't talked to anybody in 2 days, so they know when to come out, and they really are finding that by knowing when to come out, when somebody's in a pattern of isolation and depression that leads in their history to a trip to the ER. God, I'm really going to pay for that comment, aren't I? Anyway, that they know to come, and they're saving that $15,000. They've got trials where that's working. And so, the working poor are the most lucrative customers right now, and you don't have to. Then you get to them. So that's why you need cultural literacy, because I would come in as a self-empowered straight white guy saying the wrong thing, and you would work with people who know how to work with those people, better than I do. I would come in and have a wrong. I've tried that. I've worked in malaria 2 years. Yeah.
Thank you. Well, that actually is an interesting point. With the working poor, my only question for our country is, why don't we vote? It's still my only question. Why don't we vote? So with the Schumacher Center for New Economics, if all the people with nothing voted, they could take all the money back from all the people that have all the money. Why is having $1 billion a white-collar crime and stealing bread to feed your kids? You go to jail. So I just think it all comes down, we're going to work on this impact investing thing, but dude, your youth, if you would just vote, you could shortcut the whole project.
All right, thanks. I missed the first 20 minutes, so I hope I didn't.
Someone just hit him over the head and he'll know what we've been doing.
I'm Charlie Crystal. I'm a serial entrepreneur and hate raising capital, but through the grace of Josh and Mal and other folks, was able to raise money for my last company. The Jobs Act enabled places like Second Market, Circle Up, and AngelList to start allowing direct private investment. It's basically an exchange, if you're not familiar with it. You sign up as a startup and put up your business plan, your video, and you're effectively pitching online to investors, angel investors, and there are thousands of angel investors that might stumble upon you or follow someone into your company. I think it was about 2 weeks ago that it finally came online where you could just click and invest like you can on E-Trade into private companies. And it's actually kind of addicting, especially for a guy like me. So I was able to place a small investment in a company alongside a brand name venture capitalists. These are all mainstream investors. Why not encourage, instead of creating our segments, separating ourselves from the mainstream, why not encourage startups, companies to go to these exchanges, and impact investors to go to these exchanges and just leverage that as a way to do that.
Are any of you guys aware of an exchange for impact investing or an exchange that would be appropriate for these companies?
I'm incredibly glad that you raised that point. I think we live at a seminal moment with regard to private capital raising. So some concerns. I know of specific vertical, so things like Polywog that are in the life sciences. And I think in general, the Jobs Act is an incredibly powerful thing. You know, having lived in Belgium, for example, where the minute you receive an option, you have to pay tax on it. Great, way to foster entrepreneurship, guys. The US does that better than anybody else, and the Jobs Act is the next step in that. I think there's going to be a lot of blood on the floor, though, as companies and investors are going to be mismatched. A lot of people who really have no business taking risk in small, private, early-stage companies are signing up through these exchanges, and they have absolutely no idea what they're doing, and they are most certainly not accredited investors. But it's better than nothing. And right now, venture firms have retreated. They're retreating from early stage in droves, mostly because the institutional investor is saying, ugh, you know what, we really like cash flow. So the exchanges are filling a gap. They're filling a very small gap, but I think we're going to see a repercussion a couple of years from now when class action lawsuits start to hit these exchanges. Nevertheless, for right now, if you are a credible entrepreneur with a credible business plan, this is a great way to do two things. One is raise capital, but the other thing is to validate your market appeal. One of the problems with venture that we hate about venture funds is the fact that a lot of venture funds self-validate. They sit there and go, we're really smart people. We made all our money at eBay, and so we believe that we can invest your capital smartly. The answer is no, 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 no. You're a lottery winner. You got lucky, not smart, which of course makes me really popular. But you know, just because you made money doesn't make you a smart investor. And the market validation that is offered by these exchanges is incredibly powerful. And I'm waiting for a couple of other concepts to come to market where that market validation gets pushed deeper and broader, and more people, the average person in the public who has access to an internet connection can go, yeah, that sounds really good, or no, oh God, that sounds terrible. And so the market speaks. And really, for the first time, the market speaks. So the last point I'm going to make is, please, please, please test your market before you show up for capital. Just because something is interesting or useful or has a great social benefit, if it doesn't have a market, it still doesn't have a market. I see things all the time that I go, nice idea, it's not a business. So sorry. It's a nice hobby, it's not a business. So, really, really important.
So 30 seconds, is that on the crowdfunding arena, I completely agree. I won't repeat. I'll just say ditto to the points that are being raised about early stage, seed financing. But on the fixed income side, there actually are models. There's a MicroPlace site, which is effectively, it's crowdfunding. You can buy a Calvert Foundation community investment note on it. Do I know what? MicroPlace, microplace.com. And so an amount as little as $20, and we've had investors as much as $50,000 on that site. You can go online and invest in a fixed income product where it is impact investing. And so there are models out there. I think we have to be careful where people are taking a lot of risk that they're not investing lots of amounts if they're not accredited and qualified.
Hi. Aaron Lampstein. First of all, I want to say thank you all for being here. You guys are great. And in the spirit, in the spirit of SVN, I'm gonna. I have a little different perspective, so I want to see if you can help me better understand. And it might be a little controversial for some in the crowd. I am going to take the bait on the 5 references to Ben and Jerry's. As an investor myself, I don't consider. If a company chooses to sell to a larger company and can actually influence them in a positive way and make change and possibly accelerate the change, that even though some things may get lost, I accept that, the net gain may be much greater. So I do not know the details around Ben & Jerry's, and I'm sorry if there were some shops that were closed, but when I hear a story like at Grayston and think to myself, well, so if they lost, I'm just going to use an example, say 1,000 jobs related to that, but they net pick up 5,000 jobs in equivalent communities, how do we make a judgment that that's worse, that we're worse off versus better off?
And I know that was more of a comment than a question, but it's exactly this thinking and the questions that you're raising that has moved my perspective about social metrics. I think you have to be very clear about what's your social objective, and then you have to measure yourself against it. And so the example you used, if what is important to you and what you value is job generation and a certain type of jobs being generated, then you need to be measuring those outcomes.
Well, I think, SVN has shown that you can grow good businesses, for a long time, the Toms of Maine, et cetera. The thing I'm concerned about is, mission insurance when the visionary founder sells. That's just my little, and in one of my companies, I have that because of the supply chain. People give us our books at Better World Books because we show them what we do with our books. We just hit 15 million actual dollars going out. 8 cents on the dollar goes out of every dollar you spend. And so that won't go away when we exit however we're going to do it, because the mission lowers our cost of goods. Or you can have your mission at workforce development and subsidies, and they sometimes go away. They don't go away with their suppliers. They do go away if people realize, oh, I don't want to touch those people. I don't want to be around those people, which was that part of the TTOBJ that I the tragedy of Ben & Jerry's, that I was personally affected by, but you can go away, and it could have gone away at Evergreen Lodge too, but it didn't. Or you can be up in the brand, and that's really hard. That's where I am with fair trade, and it's just real hard. Alter Eco's finally got a product out this month in its truffles that are all over, exclusive for 2 months at Whole Foods, that has enough margin to cover all the social costs that they put in. But it's taken us a long time to get to that place where all the social cost is covered in a high enough margin thing. And so, yeah, well, the truffles are great in multiple ways because they're great, but we're also carbon negative, so your footprint goes down as you eat chocolate. So that's kind of an interesting thing. And they figured out a compostable package, so you can just toss the wrapper away. It's completely guilt-free. Oh, and by the way, it's fair trade. And that's how we're leading as the fourth element. But that's still at risk, only if we can make the margin tied to the mission will we have mission insurance there. And that's why I'm getting everybody else to help me do that, my formerly limited partners.
What's funny is in the nonprofit work we do, one of my favorite advisors always says, no margin, no mission. And it's true. And when you morph the nonprofit and the socially responsible together, there's organizations trying to do good, and there's a lot going on and that we don't have time for in terms of what that looks like structurally in the world and how these big pools of capital are going to approach doing good. We had two people. Is Joel Solomon here? Did he stand us up? All right, Mark Albion? Are you serious? All right. Okay, so we have time for 2 more questions.
Michael Welch, Watershed Capital. We help funds and companies raise capital. It's more of a comment about scaling the space. We worked with 60 funds in the past 5 years. Over the past year and a half, we've seen about 600 million raised out of the 15 we've worked recently. And I think the common theme we've seen are these funds that have top quartile, top decile returns, but then also have impact. So I think part of this is changing the conversation to smarter money, that you can actually, if you're not invested in this space, you're leaving return, i.e. environmental and social return, on the table.
Before you sit down, so would you say, this is what gives me the most hope, are there major investors that if they could find a place to invest money sensibly and do the right thing, would they do it?
Sure. I think it's like why wouldn't you? Smarter money. I mean, if you can get the same return as you would in traditional funds, but then you can get this other return, this added benefit, yeah, I mean, it becomes, you're not being a savvy investor if you're not invested in the sector.
So that's why I feel it's not a market question. The market is universal. Everybody wants to do the right thing. If they have money, why not get a higher return by doing the right thing with it? The challenge is our own challenge in the space, but you guys.
So I just want to say on this point, for people who like data and are very interested in data, There's a new report that just got issued that was sponsored by Sonin Capital, S-O-N-E-N, and that was also, I think, funded by KL Felicitas. It actually is looking at their portfolio that they've done out of that foundation, Charlie and Lisa Kleisner, and it's an excellent report in terms of data for funds and the returns. Were you guys involved in that? I see nodding over there, but they may know more about it than I do. Well, so the conclusion that's drawn in that report is that you can actually outperform the market investing in sustainable and responsible funds, which includes some impact investing funds, but is broader in its scope. We could have a long debate about whether that is the case, but at a minimum, it is demonstrating that those funds are competitive with traditional mainstream funds.
I think it's really hard, actually, because when you get into the nuance, I'll just give you an example. We were asked to invest in a fund recently, and we really like what they do. Their first-time fund is returning 2.5 to 3x. Brilliant. They're investing in genetically modified food. Not so great, right? However, what they're investing in is a new grass that has doubled the level of protein and doubled the level of fat so that it can be fed to cows and substitute corn. So, okay, grass-fed beef, great. Genetically modified grass. And so if you start to get down into the nuance, you have to decide which boxes you're going to tick and which boxes you're not going to tick. Because it's not that simple. You can't say, we're not going to invest in genetically modified food unless it's actually serving a greater good. So, terrific that we have new metrics, terrific that we can measure by metrics, but at the end of the day, it still comes down to what's the individual deal flow, how is that individual deal flow then creating the greatest impact, and returns. We love the fact that these guys have returned 2.5 to 3x in their first fund.
Last question. Hi, Matthew Colbert, Spend Consciously. So at the beginning, Dan, you talked about the coolness factor. Kevin and Lisa, you mentioned throughout about making it easy for people to invest in what they personally believe in and align your values with it, so there's more of a kind of a democratization of it as well as invested. So technology is our friend in this concept. We have an app and a website that will allow you to just make your own profile, be able to use this device, everyone knows it, smartphone, scan a barcode and figure out whether what you're buying matches your values. And that way you can start to be an impact investor with only $25. So it's just one of these new enterprises in which the big data gets all aggregated together, and that way we're really focusing on what a company's mission is. And I'll stay completely outside the Ben & Jerry's fight, but that way you can reward companies that you believe in. So that's all. Thank you.
How about the last question? Yeah, we have time for one more. Do you want the last question?
Can it be from a woman? Yes.
Hold on. Maybe that's the problem with this whole space.
Hi, I'm Lori Emmerich, a new member, Building for Progress. And my question, I come out of the philanthropic sector a certain amount, and I'm curious, two things. Why in the U.S. are some foundations that seem like a no-brainer to be doing impact investing are not yet, and what actively can we do to move them? And then I'm curious, in Europe, is this situation in terms of individuals, foundations, institutions doing this kind of investing, is it much greater, less? In what ways is it different from in the United States?
Just, I think foundations are weak because they were built to be weak and to be captive to the financial market. And so, they just give out 5% and then they're captive to the financial market. That's the way Andrew Carnegie wanted it when he did the Gospel of Wealth that became institutionalized. So they're weak because they're supposed to be weak.
Yeah. So I think it's actually a little deeper than that. And So traditional modern portfolio theory, which is the premise of most investing, is so focused on profit maximization, and the way that people are rewarded in these organizations, in foundations and universities and hospitals, all these organizations that have huge endowments, the people who manage the investments are rewarded based on how much return they make for the organization. And so between their training and the way they are taught to invest, which is completely focused on profit maximization, and the way that the incentives that are built into their jobs, I think it's very difficult for them to take the chance that they're going to be off their benchmark, which is, if they're off their benchmark, they might get replaced by somebody else. And it also is a system where the people who are running the organizations don't necessarily have expertise in finance, and so are very reluctant to challenge the people who are managing the investments. And so even though the investment processes and policies can be very inconsistent with the overall mission of the organization, there's not a lot of challenging of even the most senior people in the organization, and certainly not of the program people in the organization, to say, we want you to do it differently with investments. And at the end of the day, the program people are relying on those investments folks literally for their jobs, because their salaries are being paid out of the money that those folks make. And so it sets up a very difficult dynamic for it to be any different. Yeah. Right. But where you are seeing change, I think you're absolutely right. It's coming from trustees. And so FB Heron is a great example, which everybody points to. But there's also Wallace Global, which has just gone 100%, right? They're a much smaller foundation, and Ellen Dorsey's been doing incredible leadership there. But the trustees have also been willing to say to the investment people, no, this is the mission, this is consistent with our values, this is what we want you to do. So it definitely has to come from the most senior part of the organization, which are the trustees.
On the European side, I think the European general social model is sort of slightly left of center social democrat. And, Europeans are accustomed to paying taxes that are in the 65, 70% range, and they realize that there's a social contract for doing so. As a result, corporations that have to operate in those markets have traditionally, and for a much longer time period than in the US, known that whatever products they sell into those markets have to carry a social vision with them. So it's been a very market-driven phenomenon based on the political system that these companies inhabit. If you speak to the leadership of these corporations, and as I do work with the family offices of them, it's very much ingrained, right? There is an acknowledgement, which is not true in the United States, that there is a social underclass, and that it is our society's responsibility to take care of those people. That's not true in the US. In the US, we continue with the mythology that anybody can make it, which is a great mythology, but it's also very damaging, because if you are somebody that's stuck, there's very little help for you. Whereas I think the European social contract is very different, and that's why corporations appear to have more of a social venturing perspective. It's because they have to within those markets.
So that's a great female question to end on. And just to frame that, so we spent the whole time talking about impact investing, and actually it turns out a fairly narrow place. And we live within the rules, but I think if we could march on Washington like the old days and change the rules, that would be pretty cool. I do think a lot of the rest of the world sees investing as different. They see investing as being more personal, more intentional. In this country, right, a product is safe till proven otherwise, and in Europe, it's the complete opposite. And so I think we do have political issues. Also, I wouldn't necessarily hang it on foundations either. I feel like we should work or wish or hope for the youth to save us, or we can work or wish or hope for the customers, which is the folks with all the money, to wise up. But the only thing that we in this space can control is what we're doing. So what did Einstein say? The harder he worked, the luckier he got. So, if is it from a girl?
Fashion, fair trade fashion company. It's a high-risk business. You know, I wanted all mission investors to invest because I wanted to protect my mission, and I didn't want to be pressured to leave behind a lot of my incredibly socially beneficial practices. But it turns out that really only 1/4 of my angel investors are mission-driven because mission-driven investors weren't willing to take a risk on this business. So for the other 75% of my angel investors, how do I manage and train them to not divert me from my cause? I'm dealing with first-time angel investors in the social space. They're learning about it. They're traditional, and I want to figure out how to manage them and teach them.
That's a great question, and only because we do have to wrap up. We're going to stay afterwards, and that's a really good technical question. But really, how to manage investors, how to attract foundations. I believe everybody is trying to do the right thing. It's incumbent on this industry and this space to solve the structural problems. It might be great if the politics changes, and it might be great if the youth takes over, and it might be great if every foundation wakes up and says, starting tomorrow, we're going to put half our money. But we can't wait for that. So what we need is great people doing great work, solving the challenges of the industry. Anyway, so that was, Deb, you want to add anything to that? No, we're not thanking each other, but you want to dance?
Thank you. I thought that was a great panel. We're not going to do planning calls ever again. Thank you, Dan. Thank you, Kevin. Thank you, Lisa. Thank you, Sonia. Dan mentioned Marching on Washington. Just a quick reminder that we have a great workshop that's being led by David Broadwin, one of our sister organizations, American Sustainable Business Council. They've got a White House summit that's going to be starting in a couple of days, so that's at 2 o'clock. And what's next is lunch. And we've got a plenary speaker, Matt Stinchcomb from Etsy, who's phenomenal. So you got a little bit of time to eat and schmooze, and then we'll see you in the dining room. Thank you all.